Japanese candlestick patterns are a popular tool for traders. Bullish reversal patterns signal a potential upward trend. Look for the hammer, inverted hammer, and bullish engulfing. The morning star and three white soldiers are also key indicators. Each pattern has a unique success rate, as noted by Thomas N. Bukowski. Bearish reversal patterns indicate a potential downward trend. The hanging man and shooting star are prominent examples. Bearish engulfing and dark cloud cover are also significant. Evening star and three black crows are patterns to watch. Understanding these can help anticipate market shifts effectively. Bullish continuation patterns suggest the current upward trend will persist. Rising three methods and upside Tsuki gap are common patterns. The rising window and mat hold bullish are also noteworthy. Recognizing these patterns can aid in making informed trading decisions. Bearish continuation patterns indicate a sustained downward trend. Falling three methods and downside Tsuki gap are key patterns. Falling window and mat hold bearish are also important. Identifying these patterns can provide insights into ongoing market trends. Indecision patterns reflect market uncertainty. The Doji is a classic example, indicating indecision between buyers and sellers. Spinning top and high wave patterns also signal hesitation. Recognizing these patterns can help traders anticipate potential market changes. Bullish reversal candlestick patterns indicate that buyers are gaining control. One such pattern is the hammer. This pattern is formed by a single candle and is often used to signal a reversal. Traders use it to go long or as a warning to close short positions. The hammer is a powerful tool for identifying potential bottoms in a market trend. To identify a hammer candlestick pattern, look for a candle with a small body and a long wick at the bottom. The top should have no wick or a very small one. The color of the body is irrelevant. This pattern is most effective after a downward move, suggesting that bulls are beginning to take control. The hammer has a success rate of 60%. When a hammer candlestick pattern appears at the right location, it can signal the end of a downtrend and the start of an uptrend. It may also indicate the end of a pullback, resuming an uptrend. Recognizing this pattern can be crucial for traders looking to capitalize on market reversals and optimize their trading strategies. The inverted hammer candlestick pattern is a single candle formation. It's a bullish reversal pattern, often signaling the end of a downtrend. With a success rate of 67%, it indicates that bulls are beginning to take control. This pattern is crucial for traders looking to identify potential trend reversals in the market. To spot an inverted hammer, look for a candle with a small body and a long wick at the top. The bottom should have little to no wick. The color of the body is irrelevant. This pattern typically appears after a downward move, suggesting a potential shift in market momentum. When an inverted hammer appears at the right location, it may signal the end of a downtrend and the start of an uptrend. It can also indicate the end of a pullback, resuming an uptrend. Recognizing this pattern can be a valuable tool for traders aiming to capitalize on market reversals. The bullish engulfing pattern consists of two candles. The first is bearish, followed by a bullish candle that completely covers the first. This pattern, with a 62% success rate, also signals a reversal. It suggests that bulls are gaining strength, potentially marking the end of a downtrend. The piercing candlestick pattern is a two-candle formation signaling a potential trend reversal. To identify it, the first candle must be bearish, followed by a bullish second candle. The second candle opens below the first, creating a gap, and closes above the midpoint of the first candle's body. This pattern suggests that bulls are gaining control after a downward move. With a success rate of 64%, the piercing pattern can indicate the end of a downtrend or the resumption of an uptrend after a pullback. The morning star candlestick pattern consists of three candles and is another bullish reversal indicator. It begins with a bearish first candle, followed by a small second candle, which can be a doji or spinning top, and concludes with a bullish third candle. The second candle's color is irrelevant, but its body should ideally not overlap with the others. This pattern, with a 78% success rate, appears after a downward move, signaling that bulls are taking charge. It can mark the end of a downtrend or the continuation of an uptrend after a pullback. The three white soldiers candlestick pattern is a powerful indicator in trading. It consists of 3 consecutive bullish candles, each with a large body and small or non-existent wicks. This pattern signals a reversal, often appearing after a downtrend, indicating that bulls are gaining control. With an impressive success rate of 84%, it marks the end of a downtrend and the beginning of an uptrend. The white Marubozu candlestick pattern is another bullish reversal indicator. It features a single bullish candle with a large body and minimal or no wicks. Like the three white soldiers, it appears after a downward move, suggesting a shift in momentum towards the bulls. This pattern has a success rate of 71%, signaling the end of a downtrend or the resumption of an uptrend, making it a valuable tool for traders. Both the three white soldiers and white Marubozu patterns are essential for identifying trend reversals in trading. While the three white soldiers pattern boasts a higher success rate, both patterns effectively signal bullish momentum. Recognizing these patterns can help traders make informed decisions, capitalizing on potential trend reversals. Keep an eye out for these patterns to enhance your trading strategy and seize market opportunities. The 3 inside-up candlestick pattern is a powerful tool for traders. It consists of 3 candles and signals a potential reversal in a downtrend. This pattern is particularly useful for identifying market bottoms, indicating that bulls are beginning to take control after a bearish phase. To spot a 3 inside-up pattern, look for a bearish first candle, followed by a bullish second candle. The second candle should close above the midpoint of the first. Finally, the third candle must close above the first candle's high. This sequence suggests a shift in momentum from bearish to bullish. The 3 inside-up pattern is significant because it often marks the end of a downtrend or a pullback, resuming an uptrend. With a success rate of 65%, it provides traders with a reliable signal to anticipate market reversals and capitalize on emerging bullish trends. In contrast, the bullish Harami pattern involves 2 candles. The first is bearish with a large body, while the second is small and bullish, nestled within the first. With a 53% success rate, it also signals reversals but is slightly less reliable than the 3 inside-up pattern. The tweezer bottom candlestick pattern is a 2-candle formation used in technical analysis. It signals a potential reversal in a downtrend. The first candle is bearish, followed by a bullish candle. Both candles have lows at nearly the same level, indicating a shift in market sentiment. To identify a tweezer bottom, look for a bearish candle followed by a bullish one. The key is that the lows of both candles align closely. This pattern suggests that bulls are gaining strength, potentially marking the end of a downtrend or the resumption of an uptrend. The tweezer bottom pattern is significant because it indicates a possible reversal. With a success rate of 56%, it can signal the end of a downtrend or a pullback. When spotted at the right location, it suggests that bulls are starting to take control of the market. The 3 outside-up pattern consists of 3 candles. It starts with a small bearish candle, followed by a bullish candle that engulfs it, and ends with another bullish candle closing higher. This pattern, with a 75% success rate, also signals a potential trend reversal. The bullish counterattack line is a 2-candle pattern, signaling a potential market reversal. It's a bullish indicator, often appearing after a downtrend, suggesting that buyers are gaining strength and possibly marking the end of a bearish phase. To spot a bullish counterattack line, look for a large bearish candle followed by a smaller bullish one. A gap exists between the close of the first and the open of the second candle. Crucially, both candles close at the same level, indicating a shift in momentum. This pattern is significant because it often marks the end of a downtrend or a pullback, signaling the start of an uptrend. When observed in the right market conditions, it suggests that bulls are beginning to take control, potentially leading to a price increase. Imagine a chart where a downtrend is halted by a bullish counterattack line. This pattern can indicate a trend reversal, offering traders a potential entry point. Understanding and identifying this pattern can be a valuable tool for traders looking to capitalize on market shifts. The hanging man candlestick pattern is a key bearish reversal signal. It features a small body with a long lower wick and little to no upper wick. The color of the body is irrelevant. This pattern appears after an upward move, indicating that sellers are gaining control. With a success rate of 59%, it often signals the end of an uptrend or a pullback. The shooting star candlestick pattern is another bearish reversal indicator. It consists of a small body with a long upper wick and minimal lower wick. The body's color doesn't matter. This pattern emerges after a price rise, suggesting that bears are taking charge. With a 60% success rate, it often marks the conclusion of an uptrend or the continuation of a downtrend. Bearish reversal candlestick patterns like the hanging man and shooting star are crucial for traders. They signal potential trend reversals, helping traders decide when to short or close long positions. Recognizing these patterns can provide valuable insights into market dynamics, allowing traders to make informed decisions. Keep an eye out for these patterns to better navigate market shifts and optimize trading strategies. The bearish engulfing candlestick pattern is a powerful two-candle formation used in technical analysis. It signals a potential reversal in an uptrend. This pattern is characterized by a bullish candle, followed by a larger bearish candle, which completely engulfs the body of the first. To identify a bearish engulfing pattern, look for a bullish candle followed by a bearish one. The body of the bearish candle must cover the body of the bullish candle. This pattern typically appears after an upward price movement, indicating that sellers are gaining control. The bearish engulfing pattern is significant because it often marks the end of an uptrend or a pullback, resuming a downtrend. With a success rate of 82%, it is a reliable indicator for traders looking to capitalize on market reversals and shifts in momentum. When a bearish engulfing pattern appears at the right location, it can signal the end of an uptrend and the start of a downtrend. Traders use this pattern to identify potential selling opportunities. Spotting this pattern on a chart can help traders make informed decisions in volatile markets. The evening star candlestick pattern is a powerful tool in technical analysis. It consists of 3 candles and signals a potential reversal in the market. This pattern is particularly useful for identifying tops, indicating that bears are gaining control after an upward move. With a success rate of 71%, it's a reliable indicator. To spot an evening star, look for a bullish first candle, a small-bodied second candle, and a bearish third candle. The color of the second candle is irrelevant, but its body should ideally not overlap with the others. This distinct formation helps traders anticipate a shift in market momentum. When an evening star appears at the right location, it can mark the end of an uptrend and the beginning of a downtrend. It may also signal the end of a pullback, resuming a downtrend. This pattern is a key indicator for traders looking to capitalize on market reversals. The 3 black crows pattern is another reversal indicator, formed by 3 consecutive bearish candles. Each candle should have a large body with small or no wicks. With a success rate of 79%, this pattern is effective in identifying the end of an uptrend and the start of a downtrend. The black Marubozu candlestick pattern is a single candle formation used in technical analysis. It is a bearish pattern that signals a potential reversal in the market, often appearing at the top of an uptrend. To identify a black Marubozu, look for a single bearish candle with a large body and little to no wicks. This pattern indicates that sellers have taken control, pushing prices down significantly during the trading period. The black Marubozu is significant because it suggests a shift in market sentiment. When it appears after an upward move, it indicates that bears are gaining strength, potentially marking the end of an uptrend or the resumption of a downtrend. The success rate of the black Marubozu pattern is 54%. When it appears at the right location, it can signal the end of an uptrend or a pullback, leading to a potential downtrend in the market. In summary, the black Marubozu is a powerful tool for traders looking to identify market reversals. By recognizing this pattern, traders can make informed decisions about potential shifts in market direction. The bearish Harami candlestick pattern is a 2-candle formation signaling a potential market reversal. It typically appears after an upward trend, indicating that bears might be gaining control. This pattern has a success rate of 53%. To spot a bearish Harami, look for a large bullish candle followed by a smaller bearish candle. The second candle should be entirely within the body of the first. This pattern suggests a possible end to an uptrend or a pullback resuming a downtrend. When a bearish Harami appears at the right location, it can mark the end of an uptrend and the start of a downtrend. Traders use this pattern to identify potential tops in the market, providing a strategic point for decision-making. The tweezer top candlestick pattern is another reversal indicator formed by two candles. It appears after an upward move, suggesting that bears are taking over. This pattern has a slightly higher success rate of 56%. To identify a tweezer top, find a bullish candle followed by a bearish one, with both candles having similar highs. This pattern can signal the end of an uptrend or the continuation of a downtrend after a pullback. The three outside down candlestick pattern is a powerful tool for traders. It consists of three candles and signals a potential reversal in the market. This pattern is particularly useful for identifying tops, indicating that bears are gaining control. It typically appears after an upward move, suggesting a shift in momentum. To spot the three outside down pattern, look for a small bullish candle followed by a bearish candle that completely engulfs the first. The third candle is also bearish and closes below the previous two. This sequence is a clear indication of a bearish reversal, making it a valuable pattern for traders. The three outside down pattern boasts a success rate of 70%. When it appears at the right location, it can signal the end of an uptrend or the resumption of a downtrend after a pullback. This makes it a reliable indicator for traders looking to capitalize on market reversals. Incorporating the three outside down pattern into your trading strategy can enhance your ability to predict market shifts. By recognizing this pattern, traders can better anticipate bearish reversals and make informed decisions. Keep an eye out for this pattern to stay ahead in the trading game. The gravestone doji is a unique candlestick pattern formed by a single candle. It's a bearish reversal pattern, often signaling a potential trend change. With a success rate of 51%, it can indicate market shifts. To spot a gravestone doji, look for a candle with a small body and a long upper wick. The lower wick should be absent or very small. This pattern typically appears after an upward move, suggesting bears are gaining control. When a gravestone doji appears at the right location, it may signal the end of an uptrend or the resumption of a downtrend after a pullback. It's a tool for traders to anticipate market reversals and adjust strategies accordingly. In contrast, bullish continuation patterns indicate ongoing buyer control after an upward movement. These patterns help traders identify opportunities to go long or add to existing positions, maintaining momentum in an uptrend. The Rising 3 Methods is a 5-candle bullish continuation pattern. It starts with a large green candle, followed by 3 smaller red candles, and ends with another big green candle. This pattern boasts a 79% success rate. The upside Tasuki gap is a candlestick pattern formed by 3 candles. It's a bullish continuation pattern, indicating potential entry points for long positions during an uptrend. This pattern suggests that bulls are regaining control after a pause. To identify the upside Tasuki gap, look for 2 consecutive large green candles with a gap between them. Following these, a small red candle should close within the gap. This formation signals a continuation of the upward trend, providing a strategic entry point. The upside Tasuki gap is crucial for traders seeking to capitalize on bullish momentum. It appears after an upward move, confirming that buyers are taking charge again. Recognizing this pattern can help traders make informed decisions about entering long positions. The success rate of the upside Tasuki gap pattern is 57%. This means it can be a reliable indicator for traders. An example chart shows a continuation move following this pattern, reinforcing its effectiveness in predicting bullish trends. Understanding this pattern can enhance trading strategies. The mat-hold bullish candlestick pattern is a powerful tool for traders. It consists of 5 candles and is a continuation pattern. This means it's used to identify opportunities to go long after a pause in an uptrend. The pattern begins with a large green candle, indicating strong buying interest. To spot the mat-hold bullish pattern, look for a big green candle followed by a gap and 3 small red candles. Importantly, these red candles should not break the low of the first green candle. The pattern concludes with another large green candle, closing above the previous candles. This formation signals that bulls are regaining control. The mat-hold bullish pattern is significant because it suggests a continuation of the upward trend. it indicates that after a brief pause, the buying pressure is back, and the market is likely to move higher. This pattern is particularly useful for traders looking to capitalize on bullish momentum. An example of this pattern shows a continuation move after its formation. The success rate of the mat hold bullish pattern is an impressive 78%, making it a reliable indicator for traders seeking to enter long positions. The in-neck bullish candlestick pattern is a key indicator in trading, formed by two candles. It's a continuation pattern, signaling potential long entries after a pause in an uptrend. This pattern suggests that bulls are regaining control, making it crucial for traders to spot it after an upward move. To identify the in-neck bullish pattern, look for a red candle followed by a gap and a green candle. The green candle should close at the same level as the red candle. This formation indicates a potential continuation of the bullish trend, providing traders with an opportunity to capitalize on the market's upward momentum. Bearish continuation candlestick patterns, on the other hand, indicate that sellers maintain control after a downward movement. These patterns are often used to initiate or add to short positions, helping traders navigate bearish markets effectively. The following three methods is a 5-candle bearish continuation pattern. It starts with a large red candle, followed by 3 small green candles that don't surpass the first red candle's high. Finally, another big red candle closes below the others. This pattern, with a 71% success rate, signals a continuation of the downtrend. The downside Tasuki gap is a candlestick pattern formed by 3 candles. It's a bearish continuation pattern, indicating potential short entry points during a downtrend. This pattern suggests that bears are regaining control after a brief pause in the market. To spot a downside Tasuki gap, look for 2 consecutive large red candles with a gap between them. Following these, a small green candle should close within the gap. This formation signals a continuation of the downward trend, making it a useful tool for traders. The downside Tasuki gap is significant because it helps traders identify moments when the market is likely to continue its downward trajectory. With a success rate of 54%, it provides a moderate level of reliability for those looking to capitalize on bearish market movements. The falling window is another bearish continuation pattern, but it consists of just 2 candles. Like the downside Tasuki gap, it features 2 large red candles with a gap. However, its success rate is higher at 73%, making it a more reliable indicator for traders seeking to short during a downtrend. The mat hold bearish candlestick pattern is a 5-candle formation used in technical analysis. It signals a continuation of a downtrend, indicating that bears are regaining control. This pattern is crucial for traders looking to identify short entry points after a pause in a downtrend. Recognizing this pattern can help traders make informed decisions in bearish market conditions. To identify the mat hold bearish pattern, start with a large red candle. This is followed by a gap and 3 small green candles. Importantly, these green candles do not surpass the high of the initial red candle. The pattern concludes with another large red candle that closes below the previous candles. This sequence confirms the bearish continuation. Traders use the mat hold bearish pattern to spot opportunities for short positions. After a downward move, this pattern suggests that the market is poised to continue its decline. By recognizing this formation, traders can strategically enter short trades, capitalizing on the bearish momentum. Understanding this pattern is essential for those aiming to navigate and profit from downtrending markets effectively. The in-neck bearish candlestick pattern is a 2-candle formation used in technical analysis. It begins with a green candle, followed by a gap and a red candle. The red candle closes at the same level as the green candle's close. This pattern is a continuation signal, indicating potential short entries during a downtrend. It suggests that bears are regaining control after a brief pause. Indecision candlestick patterns, as the name implies, occur when the market is uncertain about its direction. These patterns signal traders to exercise caution and wait for clearer price movements. They are not ideal for making trading decisions, as they reflect market hesitation. It's wise to avoid trading during these times and instead wait for decisive action that indicates a new trend is forming. The Doji candlestick is characterized by a single candle with no body or a very small one, and wicks on both ends. The spinning top is similar, with a small body and larger wicks. Both patterns indicate indecision in the market, urging traders to wait for more definitive signals before making moves. The high wave candlestick pattern is a unique formation in trading charts. It consists of a single candle, characterized by its distinct features that traders should recognize. To identify the high wave pattern, look for a candle with a very small body and unusually large wicks both above and below. This distinctive appearance sets it apart on your charts. While it may resemble the spinning top pattern, the high wave's wicks are significantly larger. This is the key difference that traders need to note when analyzing their charts. Candlestick patterns like the high wave can signal market trends. They may indicate a bearish or bullish move or suggest market indecision. In such cases, it's wise to wait for a clearer direction before trading. For those interested in exploring these patterns further and understanding their success rates in various scenarios, consider reading a specialized book on candlestick patterns for deeper insights. Gimlet Zamim Summers